Good afternoon, everybody. It's my great pleasure to welcome you to this year's African Aviation Conference on behalf of lead sponsor Standard Chartered Bank. It feels very strange to be recording this in my living room in Dublin and not with you all in Johannesburg as usual, for some good chat, hopeful deal making and lovely warm weather. Very strange to be here, but it has been a very strange year for us all. The African aviation industry has been no less impacted than anywhere else. Despite the African governments making a fantastic effort to stem the flow of the pandemic across the continent, the airlines have been badly impacted by its ravages, and all of us in the industry have a role to play helping it get back on its feet in the winter time and as we go into next year. I'm very pleased to welcome you on behalf of lead sponsor Standard Chartered Bank, and I know that we'll have a great session today. We're particularly pleased also to be able to be joined today by my colleague Sarah Bainton-Glenn from the bank's research unit. I asked Sarah to join us because I wanted to set the macroeconomic picture for the African airlines before we turn to the individual airline upon airline overview that I'll provide at the end of this session. Before I hand over to Sarah, I'd like to just show you on the next slide a brief overview of Standard Chartered's aviation business and maybe tell you a little bit about what we've been doing to play our role in helping the airline industry fight the impact of COVID. Since the start of March, we've closed $2 billion worth of transactions with a number of airlines right across the world, not just in Standard Chartered's traditional heartlands of Asia, Africa and the Middle East. We've done a lot to help our customers with their liquidity raising efforts, although of course we're always keen to do more. We've purchased 19 aircraft on sale and leaseback, and we've helped with the refinancing of a further 10 787s for a couple of airlines. We're pleased to be playing our effort to help the airlines in their liquidity raising initiatives, and we've also had a role in a number of DCM deals and also revolving credit facilities. In Africa, on the next slide, you can see that we have a fairly significant presence as a bank, which is very long-standing. We'd always like to be doing more business with the African airlines, and we're actively evaluating a number of transactions at the moment. I hope to be able to tell you more about them in a year's time. For now, I'd like to thank you for joining us today and hand over to my colleague Sarah, who put the macroeconomic picture together before handing back to me for an aviation-specific overview. So Sarah, thanks for joining us, and over to you.
Thank you, Will. If we could turn to the first slide on the Africa economic outlook, I think what's very clear is that 2020 has been an extremely difficult year for the global economy. If you look at this chart, you can see that in 2020, we're likely to see a fairly deep contraction in global economic growth. We're forecasting minus 3.8% in 2020, and that's the deepest contraction we've seen in global economic growth since just following World War II, and it's also the deepest contraction that we've seen, or a much deeper contraction that we saw even during the global financial crisis. Now, that's been driven by a combination of the COVID-driven slowdown that we've seen in domestic activity in a number of economies throughout the globe. We have seen the implementation of local lockdown measures, as well as restrictions on travel and the movement of people. And that's had a significant impact on the growth outlook for the global economy more broadly. If you look at the larger economies globally, we're only expecting China to see some growth in 2020. But I think the key question when looking at this chart, looking at the extent of the slowdown that we're likely to see in 2020 is when are we going to see a turnaround, and what is it going to take for us to see that? Now, in 2021, we're expecting to see a bit of a recovery in global growth. We're forecasting a 5% increase in growth in 2021. But clearly, as we've seen over the past few weeks, with the resurgence of cases in the Euro area, record high cases of COVID in the US as well, that path to growth isn't necessarily going to be clear or fast. If we could turn to the next slide and onto sub-Saharan Africa more specifically, I think the one positive from the pandemic this year has been that sub-Saharan Africa hasn't been as impacted by the health crisis as had initially been feared. The COVID pandemic did reach the region relatively late. We only saw an uptick in cases in sub-Saharan Africa from March, when they'd already started to pick up in the Euro area and Asia, for example. And that meant that actually we saw lockdown restrictions taking place in sub-Saharan Africa at a time when cases had yet to pick up more significantly. And that's been seen as one of the reasons why the region has been less impacted, at least from a health perspective, than some other economies globally. Another couple of explanations for why that might be being that, firstly, the region does have a very young population. We've seen elsewhere that youth tends to be a positive factor for recovery from COVID, but also the region does have a warmer climate. We saw in the Euro area, for example, earlier this year, that during the summer months, the spread of the virus was less severe. So for that reason, the region appears to have been relatively less impacted than other countries globally. South Africa has composed over 50% of the region's cases. We did see lockdown measures to varying degrees in different economies. South Africa seeing, for example, some of the strongest lockdown measures that we saw globally, including prohibition on the sale of alcohol and tobacco and a curfew. Nigeria and Kenya also seeing restrictions on a tighter scale in Kenya, for example, in Nairobi and Mombasa, in Nigeria, in Lagos and Abuja. But clearly what is very clear from these charts is that actually the health impact of the pandemic hasn't, so far at least, been as severe for sub-Saharan Africa as it has been for other places globally. If we turn to the next slide as well, please. I think, however, what is clear is that the economic impact for sub-Saharan Africa is still going to be severe. We are expecting that growth for the region as a whole could contract by 3.2% in 2020. And that follows several years of positive growth for the region. If you look at 2000 to 2015, for example, the region saw growth on average in excess of 4%, and actually much worse performance even than we saw for the region during the global financial crisis. And there are a couple of reasons why the region is particularly badly impacted this time around. Firstly, clearly we saw the region going into the current crisis in a relatively weak position. The region's oil exporters have yet to recover from a quite protracted period of weak oil prices from the end of 2014. And then if you look at the biggest economies in the region, South Africa as well, pretty much seeing no growth in 2019, is likely to see a contraction in growth of around 8% in 2020. If you look at the three largest economies in the region, the oil exporters, Nigeria and Angola and South Africa, those three economies compose almost 2/3 of the region's GDP. So weak performance in those economies is really weighing on the outlook that we see for the region as a whole. On the chart at the bottom here, though, you can see quite clearly that actually the performance of the region is going to be quite mixed. There are economies in the region, the oil importers typically in East Africa, like Kenya, Ethiopia, Uganda, Tanzania. Although they are seeing quite significant slowdown in growth in 2020, are likely to still see positive growth, while other economies, some of the larger economies, are likely to see quite a significant contraction in growth. Now the crisis this year, on top of the health crisis, also comes following several years of an increase in debt ratios for the region. If we could turn to the next slide as well now, please. And on top of that, the oil price crisis that we saw from 2014. And even pre-COVID, we did see a big pickup in debt ratios across the region. If you look at Mozambique, for example, even in 2019, its debt to GDP ratio was over 120%. Angola this year also likely to reach those sorts of levels. But even beyond that, the likes of Ethiopia and Kenya also saw a big increase in their debt to GDP ratios as a result of a high amount of public infrastructure spending. But also we saw quite a prolonged period of heavy external issuance from the region with access to international capital markets that really drove those ratios higher. Now that's really brought debt sustainability into focus in 2020 as well. If you look at the region's economies, not only are they facing additional strain on the expenditure side to deal with the health crisis, support the economy during this current stress, we've also seen quite a significant reduction in revenue, whether that be as a result of weaker domestic activity or commodity prices than the likes of Nigeria and Angola. And as a result of that, interest payments as a percentage of general government revenue has picked up by quite a lot over the course of 2020. And that debt sustainability issue has been one of the key issues during the current crisis on top of the health issue. And if we could turn to the next slide as well, we have seen actually quite a lot of multilateral and bilateral support for economies in the region in response to that problem. Over the course of 2020, we've seen a huge amount of support from the IMF for economies in the region via either rapid credit facilities or also increasing the size of existing programs in the likes of Angola, for example. But we've also seen under the G20 agreement in April, debt service suspension for the world's poorest economies, of which sub-Saharan Africa has a number of economies that are beneficiaries of that. So under the G20 agreement, economies within sub-Saharan Africa that choose to participate originally were able to get debt service relief from May to December of 2020. That has now been extended through to the middle of 2021, with a review of that to be held in April of next year. And that's provided a significant amount of external liquidity relief for economies in the region that have seen a big increase in their debt service due over the next few years. Now, within that, the participation of China within the debt service suspension initiative has been particularly important. And you can see this in the chart on the right-hand side. Some economies in the region have as much as 50% of their external debt owed to China. If you look at Ethiopia, Kenya, for example, in excess of 20% of their external debt is owed to China. So China's participation in the G20 debt service suspension initiative, their decision to provide debt service relief to economies in sub-Saharan Africa this year is particularly important. And we have beyond that seen discussions with China, with individual economies like Angola, like Zambia, on further reprofilings beyond 2020 that could provide a significant amount of debt service relief for the region. I think the other key issue in terms of an economy's participation in this debt service suspension initiative has been twofold. Firstly, we have seen some economies in the region choosing not to participate. So Kenya, Ghana, Nigeria, for example, saying that they were concerned about their ability to access markets if they were to participate in the G20 DSSI, so they've chosen not to. Secondly, we have seen increasing calls for the participation of private creditors, so Eurobond holders, for example. Zambia has been the first economy to formally request debt service relief from its Eurobond holders, but some concerns around both the credit rating implications as well as the potential future market access for economies that were to look for more private sector participation. If we can move to the next slide, I think just to summarise on the sub-Saharan Africa picture, firstly on the monetary policy side, we have seen a huge amount of monetary policy support, not just within sub-Saharan Africa, but globally. We've seen in excess of 200 basis points of policy rate cuts from the likes of South Africa, Kenya, for example. And although we have seen, we think, mostly the end of that easing cycle for now, we do think that there is still a huge amount of monetary support that has been provided from the region. But nonetheless, we have seen some decrease in FX reserves in particular, and that's likely to continue even despite the support that we've seen from international creditors in particular. Now, that's been the result both of the need to support currency, so in the likes of the East African countries like Kenya, some support of local currencies has resulted in a decrease in FX reserves. Also, of course, clearly the region's economies that are more reliant on tourism, like Kenya, also impacted by weaker inflows, but also the region's oil exporters like Nigeria, like Angola, also seeing pressure on their external accounts in particular. I think finally, just to turn to the final slide, in terms of our outlook for currencies in the region, clearly we had seen for some time some strength in the dollar. There are a number of factors that supported that, including stronger US growth compared to other developed markets, also early and relatively aggressive Fed hikes. But actually, we think from now on, actually, we're likely to see a period of US dollar weakness, and that's regardless of what result we see in the US elections in the next week. So that should be a positive in terms of the region's currencies. The big beneficiary of that likely to be the South African rand. The rand being somewhat of a barometer for appetite towards emerging market more broadly does tend to be impacted more by those global markets dynamics. But for a lot of economies in the region, we've continued to see a fair amount of volatility. And also the depreciation trend that we've seen over the past few months is also likely to continue even despite some of that US dollar weakness. And that's largely because the domestic fundamentals, the issues like weaker oil revenue, weaker revenue from tourism and also trade are also likely to impact on the currency outlook. So I think just to summarize it in total in terms of the sub-Saharan African outlook, clearly 2020, as with the global economy, is likely to be a difficult year. We are expecting growth to contract for the region as a whole, but there are pockets of economies in the region that are still likely to see at least positive growth in 2020. And we are expecting a recovery to continue into 2021, along with the global growth recovery that we're likely to see. If I hand over back to you now, Will, as well for a bit more detail.
Thanks very much for that, Sarah. It's interesting to see the macro picture because obviously globally airlines have been hugely reliant on state support to get them through the last 6, 7, 8 months. And in Africa, it's going to be no different. IATA recently announced that the African governments have pledged some 30 billion to African airlines. There's clearly at this time of very high indebtedness from the African governments going to be some challenge in supporting all of the airlines across the continent in the way that the governments would want to. And indeed, IATA has also commented that a fairly small proportion of that 30 billion that has been pledged has actually been advanced to airlines. Rwanda is an example of an airline that's had a government injection recently. And obviously, we've seen great debate around whether it's appropriate for the South African government to continue supporting South African Airways. I think the interesting thing that you picked up at the end there, Sarah, was the likely US dollar softening. That combined with an oil price in the kind of 40s, which we see as being roughly where it's going to trade for the next little while, is going to provide some elements of support and relief to the airlines as they have their largest outgoings, lease costs, financing costs, oil costs, all typically in US dollars. So coming now to the impact of COVID on the African airlines, you can see here on this slide IATA's data for August, which was released at the end of September. Wasn't a very good summer, to put it mildly. And you can see there that the African airlines have been particularly impacted because of the effectiveness of that government shutdown, which, so as Sarah picked up, which stymied very, very well the flow of the pandemic across the continent. You can see that the RPKs and ASKs from the African airlines are almost, the reduction is almost as large as anywhere. However, if we turn to the next slide, there has been a bright spot for the African airlines, and particularly there's been a fair amount of press around Ethiopian, very agilely changing its operations very quickly from passenger to freighter operations. And you see here the slide which just shows globally what's happened as the passenger numbers have dropped off, how freighter operations have picked up, driven by e-commerce, driven by the need to transport personal protective equipment. And that's a trend that we're going to see carrying on given the large volume of retirements of passenger aeroplanes and also the reduction in passenger flight schedules, which we're anticipating going into 2021, given that so much air cargo is carried in the bellies of passenger aeroplanes. I'm conscious of time, so coming on to the next slide, I'm not proposing, which sets out an overview for you of all of the African airlines, certainly who are at this conference, and a few other big names across the continent. I'm not proposing to go through airline by airline the impact of the pandemic. I just want to pick out a couple of things, and indeed a couple of reasons for optimism, really. Whenever you have a situation like we've endured over the last year and are still going through, there's always an opportunity that comes out of it. And I think you're seeing the African airlines start to react to that very smartly. This week, you had over in the west of Africa, you had an announcement from the Ghanaian government that they're going to tie up with Egypt Air to launch a new flag carrier. And I know we'll hear more from Mr. Gazy of Egypt Air later on that. I mentioned Ethiopia in the east and their extremely agile response to the crisis. And my colleague Sarah picked up the difficulties that the South African economy is having, and that's also flowed through into recent cessation of operations by South African Airways. However, we've seen the private carriers in South Africa step up, and I hope that's a trend that we'll see across the continent. government finances are likely to be stretched, and where Airlines and Safair are leading the way, hopefully other private carriers can step in and help with the support of the banking and leasing. I wanted also, just before closing, to throw up the next slide, which gives you an overview of deliveries this year into South Africa, into the African market. Sources of financing available for the African airlines are many and diverse, and I think it's going to be critical as we look through the end of this year and into next year that all of the financing community steps up and plays its part. There's always likely to be a sale and leaseback available for an airline facing a delivery, which gives them the benefit of 100% financing. However, with financing costs having ticked up so much for lessors over the last years, we're going to see that becoming an increasingly expensive form of financing. There's many other options that African airlines have in their toolbox, and it's going to be important that everyone attending this conference works together, particularly those African-focused development banks, EXIM, ECAs, and we hope possibly some role for the private credit insurance as we see the market develop into next year. I've shamelessly stolen in the next slide Boeing's commercial outlook, which was recently published for the African market. You can see that they've reduced the number of aeroplanes that they're expecting the market to need over the next 20 odd years, but there's still a sizable opportunity. And I think it's important as we go into today's sessions to keep in mind that there are reasons for optimism for our industry. As Sarah mentions, we're expecting to see the corner be turned by the global economy as we go into next year. Even this week, we're reading about vaccinations being likely to be available before the end of this year. And we should keep in mind, as the next slide shows, that we're operating in a highly resilient industry. Boeing bravely published their commercial forecast recently, and they were talking in that about taking around 3 years to get back to 2019 levels of air travel. However, it's important to remember that that was a record year. Now, it will take longer beyond that. They also say to get back to the trend line that we see there. It's important to remember that aviation does always come back to that trend line through all of the crises it's faced in the past, whether 9/11, whether SARS, the global financial crisis. This is the largest crisis that our industry has faced, but I think there's no doubt that it will recover with everybody working together to try and make that happen. And particularly with the African market, as you can see on the final slide, there's real reasons for optimism. Not only the lesser health impact of the pandemic, but also nothing that's happened in the last year has changed those underlying factors which are driving the continent's growth and which make it such a potentially huge market for the aviation industry. The second most populous continent, the youngest continent, a need for air transport, coupled with an industry that's willing to provide it, and I hope many lessors, banks and financiers wanting to work together to make it happen. So with that, I'd like to close. I'd like to congratulate Nick and the whole team in African Aviation for getting us together through such challenging circumstances and wish you on behalf of Standard Chartered Bank a very enjoyable conference. Thank you very much.